Starbucks is reinventing itself. And so the question is, should we be buying the shares of this company ahead of that reinvention? That's what we're going to dive into in this video. So guys, smash that like button, subscribe if you're new, and of course, if you're one of the cats that watches this video, drop a meow in the chat. You're watching More Money, let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And this is a very interesting situation because Starbucks financially is doing okay. But what's happening is that there seems to be a unionization push at Starbucks, which is causing upper level management to really reevaluate the working conditions in the company and make it a better place overall for the employees to be. And so let's back up a second and let's dive into sort of what this story is, what they're doing, and what this means for the top and bottom line. And then I'm going to give you a valuation to suggest whether or not we should be buying this company. And of course, it's never financial advice, but you know what I mean. I just share the research that I make. So you can see here that in March, their recent CEO actually stepped down, and Howard Schultz, the guy who created the company, came back as the interim CEO. And one of the challenges that the previous CEO that just stepped down was facing is that there was a very pro-union sort of movement happening at Starbucks. If you recall, there has been a growing nationwide campaign amongst the chain to unionize, and it all started in Buffalo. There was one store in Buffalo that voted to unionize, or at least tried to vote to unionize, and then it just sort of took on from there. And when Howard Schultz came back, in his first week back at Starbucks, 7 more company-owned cafes unionized, bringing that total number up to 16. And so what did he do to sort of address that? Well, he stopped buying back shares, and they're going to sort of reevaluate what to do with that capital. Now, I actually think that the share buyback is related to something else, which I will explain later in the video, but it's good that he's focusing on this head on. He's not just sort of keeping the seat warm for the next CEO. He's addressing these issues and going after it. And I'm going to show you exactly how he's doing that. And note that this was an ongoing issue. Their previous CEO, Kevin Johnson, was already sort of facing accusations of union busting by Workers United. And today, it's still not a lot of stores, but there's more than 180 company-owned locations that have filed petitions for a union election. And so that amounts to around 2% of their overall US locations of 9,000 stores. And this is what caught me a little bit off guard. There was a Gallup poll that from September of 2021 that shows that 68% of Americans approve of labor unions. That's the highest reading since a 71% approval in 1965. So that really caught me off guard and shows that I'm myself admittedly a bit out of touch with how regular people are feeling with these types of jobs. And it is a very good reason why many people have not returned back to the workforce at this level. And so it makes a lot of sense. Look, at the end of the day, I did my fair share of entry-level work, and it was always a drag. And so doing those types of jobs really pushed me to make something of myself. And if those sort of like employment conditions are much worse, because of course the dollar's not going as far as it did before, of course I could see why people wouldn't want to go back into the workforce if that's what they got to deal with. Now here's what Howard Schultz has come out with. They recently released this on July 11th. It's clear to me from even the picture that was chosen here that this will be all about their employees, which they call their partners. And so they're really reinventing the company. And so how are they reinventing the company? Well, it's not with the products, that's for sure. And the whole point of this, which you can see here, is that they're focusing on 5 major things to reinvent themselves. The first one is re-envisioning how they bring their mission to life, which I don't know what that means. The second one is renewing the well-being of retail partners by radically improving their experience. So of course, making it better to work at Starbucks. 3, reimagining their store experience for greater connection, ease, and a planet positive impact. So that's probably more closer to your ESG sort of compliant issues. 4, reconnecting with our customers and delivering memorable and personalized moments. Not really sure what that means. Are they not doing that right now? I don't think so. And then redesigning partnership by creating new ways to thrive together. So a lot of that is sort of like high level sort of like wording, but I think the most important thing there is they're looking to make it a better place to work for their partners. That's really what I'm reading. And I do highly encourage you guys to read that whole document. They're going to provide more details later on, but it's very clear that they're going after becoming a better place to work for their employees. And so the first question is, what are the impacts to sort of Starbucks on the financial statement level? You can see for the top line, I think very little happens. I think they're still growing in the low double digits and into the high single digits in 25 and 2026. And I do believe that their gross margins are going to continue to be strong at the 30% range. Where I believe that this will have an impact is on their SG&A line. I forecast an increase from around 6.5% to 8% going forward. And of course, that will impact operating profit and the ultimate valuation. But here's the thing. If you want employees sort of like work life to feel better, you're probably going to have to staff locations appropriately, maybe overstaff them a little bit so people don't feel stressed out. Like, when was the last time you went into a Starbucks and you didn't see one person doing the job of two people? I've always sort of noticed that anytime that I was in a Starbucks location, but it might just be the time that I've been in there, but I've always seen the staff hustling. I think very few people work harder than they do. And so I always thought that they could use a couple more people on the floor. So I think that's the direction that they're going to go. Hopefully they don't bump into each other and make themselves less productive, but I don't think that's going to be the case. And so what that really does is I really think that that pushes up that SG&A line by 150 basis points. So what does that mean for the bottom line? And before I go into the valuation, I wanted to sneak this in to just show you what's happening. Note that they weren't kidding. They actually canceled share buybacks, but I think they just opportunistically did that as the debt levels were getting a bit high. So they used that buybacks cash to actually pay back debt. And I think that they're going to have to pay down more and more debt as time goes on. Look, it doesn't make a lot of sense to me that a company is issuing debt while simultaneously buying back shares. Like, why increase the amount of leverage that you're holding as an organization just to buy back shares? Like, keep the balance sheet clean. Now, I understand that there is an argument for an efficient amount of leverage in the business as a whole. I get that, but I'm just sort of old school. I believe in just business operating with no debt, especially a business with as high margins as Starbucks. And you can see that in my excess capital calculation that the debt levels are a tad bit high, and I do penalize a valuation for this, which you will see in the next slide. So you can see that there's around 14 or 15 billion dollars of debt here. And so they have a net excess capital of a negative $8 billion. And so you can see from the valuation that the multiple that I'm using might be a bit high, but I did that on purpose to show that despite the multiple, it's still a bit expensive. And I don't think the market has digested just what this new era for Starbucks really means. And what I mean by that is the hit to the bottom line with a higher SG&A cost. Also note that I gave them a debt penalization. That's from that excess cash calc that you just saw. Dive into the model for the Patreons that do have access to it to see how I did that. But overall, you can see that I'm valuing the company at $60 per share. They're currently trading at $78 per share. So the price to intrinsic value is approximately 130%. So I don't want to buy this company at the current share price. I will absolutely buy it at under $40 per share. But once again, that might be a pipe dream. I may not necessarily get to that share price, and that's okay. I'm willing to wait. Now, if you want access to that Starbucks model and all the other models that I show on this channel, you can get access to that at the lower tier for the Patreon membership. And if you want to join us for an epic live presentation where I save my absolute best work and research for everyone for that live call, you can get access to that at the upper tier of the Patreon membership. And like I always say, there's never any risk to you, because if you decide to try it out and within the first month you decide that it's not for you, no problem, I'll fully refund your first month subscription. And the one thing that I did mention earlier in this video is that I do believe in a clean balance sheet. And one of the reasons why I believe in a clean balance sheet is because you never know when the economy is going to turn. And I do believe that right now we could be facing a consumer-led recession. And Michael Burry actually agrees with that opinion that I hold. And he actually went further and predicted what I refer to as, or what he refers to as, a bullwhip effect. And I actually covered that in this video right here.